If you're a small business owner earning real money, the real cost of an IUL isn't the fees on the illustration. And obsessing over low fees is one of the fastest ways to design something that works on a spreadsheet and collapses in real life. Two people can fund the exact same premium into what looks like the same policy at the same carrier and end up millions of dollars apart in outcome. That's not opinion, that's structure. And this is where most high earners get burned because they think fee sensitivity equals sophistication, when it actually blinds them to the risks that matter the most. Because here's the uncomfortable truth. If your financial plan only works when nothing goes wrong, it's not a plan. It's a fantasy. So stay with me. In a few minutes, you'll see why asking about fees doesn't really protect you. It just quietly sets you up to fail later. Hello, my name is Robert Balgac. I'm a founder and CEO of Black Swan Insurance Group. And since 2017, we've worked with over 20,000 families and earned 800 plus five-star Google reviews by focusing on something most advisors avoid: designing financial structures that have to survive stress, not just sell well in a meeting. So if you want to know whether what you build actually holds up when markets, the IRS, or your health intervene, you can click on the link below and book a tax-free wealth strategy session with us. No pressure, just math and clarity. Because once you see what I'm about to show you, the fee conversation won't make sense anymore. Let me introduce you to Linda. Linda is 45, second-generation Asian American, a real estate entrepreneur who built everything herself. No employer 401k, no pension. Her wealth lives in properties, deal flow, and taxable accounts. She's a classic tiger mom. Her life is structured around her kids, school drop-offs, piano practice, math tutoring, debate club, college planning. College isn't a hope in her household. It's a non-negotiable outcome. And Linda did what disciplined business owners do. She reinvested the profits into the business, kept leverage conservative, maintained liquidity buffers. From the outside, it looked airtight. But underneath the discipline, Linda felt exposed because she understood two truths she couldn't escape. If she couldn't work, income would slow immediately. And when she eventually stepped back, the IRS would finally take a permanent seat at the table. That's what brought her to an IUL. And like most intelligent, skeptical business owners, her first question wasn't emotional. It was analytical. What are the fees? She compared illustrations side by side. One looked cheaper early, one looked heavier upfront. Same premium, same carrier, same indexes. She almost chose the cheaper looking one. And that decision would have quietly broken the plan later. And this is where most high-income business owners step on the landmine. Why fee obsession is the wrong lens. Feels feel concrete. Design feels abstract. So people focus on what's easy to measure, even when it's the least important variable. Here's the reality. Fees are static line items. Risk is structural. The real cost of an IUL doesn't live in the visible changes. It lives in what happens when life deviates from the spreadsheet. There are three variables that actually determines outcomes. Number one, how cost of insurance behaves over time. Number two, how the death benefit is engineered. And number three, how premiums are funded and flexed. Miss any of those, and the low fee policy becomes the most expensive mistake you won't notice until it's too late. Design determines the outcome. And this isn't magic, it's math. Cost of insurance, the compounding drag no one watches. Cost of insurance isn't a one-time expense. It's a rising internal charge that accelerates as you age. Under IRS Code 7702, the death benefit structure determines how efficiently your premium converts into usable cash value. Linda committed to $3,000 per month funding, $36,000 a year for 20 years. That's a total funding of $720,000. Two designs allowed it. One stretched the death benefit to minimize visible charges early. The other one compressed it intentionally. The stretch design looked cleaner in years 1 through 10, lower charges, better optics. But later, as Linda aged, rising insurance costs began eating the policy from the inside. The compressed design did the opposite. It looked heavily early, but stabilized long-term. Same dollars in, different math. Because this wasn't about chasing returns. It was about survival. And in a minute, you'll see why this distinction mattered more than anyone expected. Funding patterns, where most policies quietly break. Linda's income wasn't smooth. Real estate never is. Some years she could overfund it. Some years she needed breathing room. One design assumed perfect funding discipline forever. Miss a year and the structure weakened. The other design front-loaded efficiency while respecting code 7702A limits to avoid MEC status. This matters because money that only works if life behaves perfectly isn't flexible money. It's brittle money. Liquidity is oxygen. And Linda didn't want another obligation. She wanted a structural layer that absorbs stress. And this strategy wasn't stacked on top of her life. It replaced future risk with intentional design. And then life interrupted everything. At 49, Linda was diagnosed with stage 4 ovarian cancer. No warning, no runway. Treatment started immediately. Her focus shifted overnight, from deal flow to survival, from spreadsheets to her kids. At that point, no one knew how this would end. The only certainty was that her business couldn't stop just because she was fighting. Her real estate portfolio was solid, but illiquid. Selling properties during treatment wasn't an option. This is where most financial plans collapse quietly, because most wealth look impressive until you need it now. And 4 years into the policy, Linda triggered a living benefits claim. That's the claim that the insurance company pays if somebody is diagnosed with a critical illness like cancer. And the policy paid out $500,000. Not a loan, not taxable income, an accelerated death benefit, conditional, design dependent, but very, very real. That $500,000 covered household expenses, medical flexibility, and day-to-day business operations. No forced sales, no panic decisions. Her kids stayed in their schools, tutors stayed, college plans stayed intact. And that's when Linda realized something profound. There are two kinds of money. Money that grows and money that still works when life breaks. Set it and steward it. So here's what happened next. Linda responded exceptionally well to a newer immunotherapy-based treatment product. 9 months after diagnosis, her scans showed remission. Not guaranteed, not promised, but real. And because financial stress had already been removed from the equation, her recovery wasn't burdened by forced decisions or liquidation pressures. She returned to work on her terms. She continued funding $3,000 per month for 20 years for the total premiums of $720,000. And despite the interruption, the structure held. Age 65, her policy is projected to have $1.3 million in accumulated cash value. By age 70, around $1.8 million. By age 75, roughly $2.6 million. And by her early 80s, over $3.7 million. It's not magic, it's math. From age of 66, she will be taking approximately $123,000 per year in tax advantage income. Not for a few years, for decades. By age 85, her total income exceeds $2.3 million. By age 94, if she makes it that long, over $3.5 million accessed on that initial contribution of $720,000. Same policy, same carrier, completely different outcome because the structure survived rising cost, aging, and a life-altering health interruption. Cost didn't kill the policy. Bad design would have. This isn't about beating the market. It's about surviving it. Because zero was her hero. So here's the verdict. Linda didn't choose the policy with the lowest fees. She chose the one that stayed functional when life stopped cooperating. She funded $36,000 per year for 20 years. She built a tax advantage income stream that didn't depend on timing, markets, or permission. All of this without triggering taxable income, without selling assets after a market drop, without asking permission from any creditor. She didn't beat the market. She beat tax drag, volatility, and timing risk. Structure replaced home. So if you're still asking, what are the fees? You're not asking a sophisticated question. You're asking a dangerous one. The real question is whether your structure survives real life. So if you would like to find out how this would potentially work for you, click on the link below and book a tax-free wealth strategy session with us. And remember, it's not what you earn, it's what you keep. Enjoy the ride.